We continue with the conversation. I think today we are winding up with the treatment of the provision for depreciation of non-current assets. So what we need to consider is how to record depreciation in the financial statements. And you and I may be aware that when we say financial statements, we're referring to, the profit and loss and other comprehensive income statement and the balance sheet, which is also the financial position statement. Mainly, those are the two that we deal with in this, course of study. But we know that there are still two more other statements that we have, and those are the cash flow statement and the statement of changes in equity. So now let's look at how to record depreciation in the income statement. Okay, how do you account for depreciation in the income statement? Remember what we said last time? We said the income statement, in the income statement, depreciation is always treated as an expense, right? It is always treated as an expense. What do you do to the expenses? Do you credit expenses or do you debit them? Anybody? What do you do with expenses? Right. Aisha, what do we do with expenses? Do we debit? Do we credit? Okay. People are quiet. Zaid, what do you think?
So what's your question?
My question is, what do you do with expenses in the income statement? Do we debit them or credit them?
So we credit them.
We credit them. You guys, I wrote something like this last time, and I'm still writing it again. These are the elements or accounts that are always credited and debited, both on the trial balance and in the income statement. We say that you debit all the assets, you debit for all the assets, you debit all the losses, and you debit all the what? The expenses, isn't it? Then on the other hand, you credit all revenue or sales, right? All the sales are credited, all capital is credited, all gains, the gains or profits, if you want, the incomes are credited, and what else is credited? Say the revenue, liabilities. All the liabilities are credited. So this you should write it somewhere in case you guys forget, but please. You guys, you should not forget. Write down in here. Is that right? Okay. Because of the same, then when I say expenses, do you debit expenses or you credit them? You have known that you debit what? Expenses, okay? All assets are debited, losses and expenses. But we credit all revenue or the sales, the capital is credited, the gains or the incomes are credited, and the liabilities are always credited. That is very important for you to understand. You should write it somewhere, because when you know this, at least you will be fine. you will be fine. Okay? You have written down this one. Do you still have someone who is still writing before you erase it? Okay, then we can erase this and move on. So let's start with how do you make records in the balance sheet. Pay attention. Here is an example. Okay, in the balance sheet, if you remember, the way how the format of the balance sheet is, it has got three columns, right? You have got the column for the cost. There is a column for depreciation year, and there is also the column for net book value. Just want to remind you of this. This is how you write, okay? So you record the name of the assets here. To be specific, these are non-current assets. Non-current assets. So what you do is you write the name, the cost, the amount of the costs, you write the amount that has been depreciated, and what remains after depreciating, which is called the net book value. And so basically, this is what does happen. So let's look at the first example. This person's financial year ends on 30th of June, and on 1st July 2023, she purchased the fixtures costing 25,000. Follow nicely. The fixtures of 25,000 were purchased and paid by check, meaning they were paid using a bank. So the person estimated that she would be able to use the fixtures for 4 years and then be able to resell or to sell them for 30,000. Kavai decided to use the reducing balance method of depreciation at 40% per annum. This is very important. 4 years down the line. So, and you're using the reducing balance method. What is it that you are required of doing? Prepare a relevant extract from Kavai's income statement for each of the years that end 30th of June. Prepare a relevant extract from Kavai's income statement. What happens in the income statement? And then later on, we'll also show you what happens in the balance sheet. So first of all, when you look at the income statement, let's start with the income statement, number one. We want to prepare for the one that ends in 2025. So we have got 20 from 2023, 24, and then ending in 25. That's just about 2 years. Okay. So what you do, you calculate depreciation for the first year, calculate depreciation for the first year, that is in 2023, okay, and record it under expenses, okay, of the income statement. So how do you find the depreciation? You just calculate in this case since this is the first year, 40% of 25,000. 25,000 times 40%. That's a 10,000. So that 10,000 is the amount that has been depreciated. But we're just showing you how you account for depreciation in an income statement. You just record it under expenses and depreciation of fixtures. Record the amount just like that. Then now, when you go to the other year, which is 2025, since we are using reducing balance method, this is very important for you to understand. Since you are using the reducing balance method, what is it that you're going to do? You're going to deduct this accumulated depreciation for 2024. So you say 25,000, which is the cost of the fixtures, less 10,000, of depreciation for 2024. What do you remain with? What is it that you remain with? You remain with 15,000, right? This 15,000 is called the net book value. That's the amount that remains in 2025. So now, we want to depreciate the 15,000. We're going to depreciate the 15,000, not the 25, no. Because the value of the asset that has remained is 15,000. So let's depreciate 15,000 at 40%. You do 40% of 15,000, 40%. So the 40% of 15,000 is actually 60,000. So that is the 60,000 that you put here again. Okay, that is the 15,000 that you put there. Is that clear? Any question? So now, in case there was another year, let's say 2026, I'm just showing you how we record in an income statement. If you had another year, like maybe 2026, okay, what you could have done to calculate for depreciation for 2026, you could have subtracted 25,000, which is the cost, minus total depreciation from the time the asset was bought. So the total depreciation is the 10,000 for 2024 plus the 60,000 for 2025. So giving us 16,000. So you deduct that, okay? Just deduct that. And once you do deduct that, you remain with, I think it should be 9,000. You remain with the 9,000. So this 9,000 again is the net book value. That's the value of the asset in 2026. Then you do 40% of this. It will give you the depreciation for 2026, and you record it just like that. So basically, that's how you record depreciation in the income statement. So in short, it is recorded as an expense. That's the summary of it. Any question? Is there any question from anyone? Okay, let me show you now how we show this same depreciation in the balance sheet that is prepared at the end of the year. So at the end of the year 2024, this is how you record in the balance sheet. I've told you number one is the name of the asset, which is the fixtures. The cost is 25. Then you less depreciation for that year, in this case for 2024, it is 10,000. Then what remains is 15,000 as the net book value. Okay, so this is the balance sheet for 2024. That's how it would look in 2024. But in 2025, it would be more like the same. It's only that you also add the depreciation for 2025. You also account for it. So there is a depreciation that has occurred in 2025, which is 6,000. So it will be 25,000. 25,000 less 15,000. That's 10,000 plus 10,000 plus 60,000. Okay, that becomes the 15,000. So the net book value or the total depreciation for 2025 is 15,000. Then the net book value shall be 9,000. Why 15,000? It's because every time when we prepare the balance sheet, okay, the total depreciation that we work with is the accumulated depreciation from the time the asset was bought up to date. That's why this is depreciation to date. Okay. So from the time the asset was acquired, we have lost the total value of $15,000. Is that clear? Okay. These are not very strange things. These are things that you have been exposed to severally. Okay. So in 2026, again, if you want to do for 2026 a balance sheet, you repeat the same. But this time around, under depreciation, you add the depreciation for 2024 plus depreciation for 2025. Okay. There was depreciation for 2023, which was 10,000, and for 2024, which was 6,000, plus the other depreciation for the other year, and which is for 2025. The total depreciation becomes 19,600, and what you remain with from 25,000 is the net book value of 5,400. Now, let's learn how we dispose of the non-current assets. Okay, this is very important for you to understand the science behind disposal of non-current assets. So the disposal of non-current assets simply means that what happens when you buy an asset and you decide to sell it, right? You sell the non-current assets, those fixed assets, you sell them. So now as you sell the fixed assets, okay, as you sell these fixed assets, the question of the day is what really happens, okay? What really happens as you sell these fixed assets? So now, the language here, or the message to us is that when a non-current asset is sold or disposed of, it must be removed from the ledger accounts because we have sold it. So we have to remove it. We no longer have it. So even on our record, we have to show a deduction. So the cost of the very asset and the depreciation thereof are removed from the asset account. Okay. So you remove the cost of that asset because you no longer have that particular asset. So this is very important. You need to get that. Yeah. So now the proceeds of the sale are also entered in this account. So it is quite likely that this account will not actually balance. Usually this is because depreciation was only an estimate of the loss in value. It was not really the actual value. So now, how do you account for the same? Let's have an example so that you're okay. The example is 12.10. The financial year ends on 30th of June. On 1st July 2023, the person purchased the fixtures of 25,000 and paid by check. Then the person decided to depreciate the fixtures using the reducing balance method. So on 1st July 2027, the provision for depreciation of fixtures accounted showed a credit balance of 21,000. This was total depreciation, okay? 21,760. That was total depreciation. So now, this person sold all the fixtures on credit to traders at the 31,100. Okay, so the person sold these fixtures. They disposed the non-current asset. So how do you make entries in the ledger account of the same transaction? That's the question. So we already know the costs of the asset. The cost of the asset was 25,000. And we know the total depreciation has already been given to us and how much these same assets have to be disposed of or sold of. So how do you make entries for the year 2028? We start in 2023. Number one, we start with the fixtures account. That is then the assets account. Okay. We start with the assets account. How do you record in the assets account? Very easy. So number one, you bought the asset using the check. So you record the cost of an asset on the other end. So when you're given an assets account, in this case, you just have to record, okay, you debit the assets account, okay, with the cost of that material. So let's say the assets in question here are the fixtures as we have them. Then you bought, so the cost of the assets, the fixtures was 25,000. So you write on the 1st of July, using the bank account, the total amount you had was 25,000. And then you balance it off, just balance off the account. Since the asset is no longer there, balance off the account. You know how we balance off? We record the biggest amount on both sides, yeah? The biggest amount is 25,000. And then the balance that remains in the next year, that is in 2027, 1 July, is disposed and it is just 25,000. You close the assets. This is the fixtures account or the asset account. I should be quick to indicate to the class that sometimes you may not just have the fixtures only, but this is the general assets account. This is how we make changes in the general assets account. Sometimes you may find the situation where you have a different asset. Maybe you have equipments, yeah. You may find yourself having equipments, but the question is, what do you do with the equipments, with the very equipments? What do you actually do? How do you treat the equipments? Okay, so that's very important for us to notice and learn that. Yeah, we need to get to learn all that. What do you do with the equipments? Right? You record in the same way, even if as long as it's an asset, a non-current asset account, this is how you record. So first of all, you debit. From the debit side, you record the costs of that asset, and then you balance off the account. The details of the balance, more like the balance carried out, will be the disposal of the non-current asset. And then there is no balance brought down. You don't bring down the balance when you sell off the assets. So this is how you balance off the assets account. It means we are completely done using that asset. Any question? Is there anybody with a question? All right. So now let's move on a little bit and see what happens. How do you now record for these same things in the provision for depreciation account? This is very important for you to pay attention. We showed you how to record the same, in the assets account, but what about in the provision for depreciation account? So you start with the total depreciation, and the total depreciation that you have been given was 21,760 in the question. So you debit that, okay, as the total value that you have. Just begin by opening. Not that. You begin by. Remember, we said that you credit the depreciation, the provision for depreciation. In this case, why do you credit this account, the provision for depreciation account? Is because when you go to the to the profit and loss account, right, the income statement, you're going to debit the income statement with the depreciation. So to observe double entry, if you debit the other account, then the other account should be credited, yeah? So you're going to credit this depreciation account, the provision for depreciation account, and with the balance brought down from the previous period, it was 21,706. That's the balance that you brought down from the previous period. Yeah, that was the total depreciation. In short, you are writing or recording total depreciation. That is very important. Total depreciation is recorded on the other side. And then from there, you can balance off the what? You can balance off this account. Okay, balance of this account, and the ending balance of 1 July 2027 actually will be the disposal. You record that as the details of the disposal of the non-current asset. So which means at disposal, right? At disposal, the total depreciation was what? 21,760. Now, how do you record the same transaction in the disposal account now? I've talked about two accounts already. I've talked about how to record in the assets account, the non-current assets account. I've shown you how to record that transaction. Now I'm just from showing you how to record the same transaction in the provision for depreciation account. Yeah. So I want to now show you how you record in the disposal of in the disposal of non-current asset account. The asset in question is the fixtures. So how can you come up with that account now? This is where you have to pay extreme attention. Pay attention. When you open the disposal account, if you're to open the disposal account, the first thing that you do is to write is to debit the disposal account with the costs. Okay. You start by debiting the account with the costs. The cost of what? The cost of the non-current assets. The non-current asset in question being the fixtures had the cost of $25,000. After you have done that, then we need the depreciation. Now, this is where it is getting interesting. What was total depreciation in 2027? The total depreciation is, we say it was that. That was the amount. Then you have to record the amount that it was sold here. Okay? The amount that it was sold. It was sold at 1,100. Record that amount. And then once you record that amount, then you can balance off the account. You didn't hear what I said. So when you open the account like this, of a disposal account, of any assets account, start with the costs, okay? The costs of that non-current asset and the details thereof you write, okay? Then from there, you record total depreciation, okay? For that particular year, write the total depreciation. Then this one is the sale value. The sale value, how much you have sold it, right here. This is the sale value. And once that, then you can balance off the account, okay? Just balance off the what? The account. As you balance it off, as you balance the account off, there will be this difference, the minor difference here, which you would call in some cases, the balance carried down, but you don't call it the balance carried down. You send this balance to the income statement, okay? As a what? It is going to the income statement to be debited. You're going to debit the income statement. And why are you debiting the income statement when you do this? This is because this was actually now a loss. All the losses are debited in the income statement, right? The losses are debited in the income statement. Why? Because when you add up total depreciation, this 21,000 plus 3,100, what do you get? Anyone to quickly do the addition? Remember the cost was 25,000. What is the total? 21,760 plus the 3,104. What do you get? Hello, what are you finding? What are you finding? Okay. Sorry? You guys, you can easily add 21,760 plus 3,100. What do you get? 24 what? Okay. 24,860. Thank you. You've seen now, you find 24,000, but how much did you spend to buy the asset? You spent, the cost was high. It was 25,000. But yeah, you get the point, right? So what happens is that what you spent to buy the asset was way higher than what you have received. Okay? The total depreciation plus what you have sold the asset, when you add them together, it's actually less than what you bought the asset. So that's why I'm saying this is a loss to you, and all losses are what are debited in the income statement. That's why you are crediting this fixtures account. That is very important for you to notice. But sometimes when you do your additions, if you do your additions, you find that this side is bigger. Okay, when you're doing your balancing, you find that the credit side is bigger. Let me just make that point. The credit side is bigger, which means the balance brought down will come this side. The income statement will come this side, maybe 1/4 to this side. Okay, so that would mean that now it's a gain to you. It would indicate that the cost is less than what you have gained from the asset. And in that case, you will debit the disposal account, which so that the income statement can be credited. Just observing the double entry rule. So if you want to observe the dual entry, you just have to make sure that one asset is debited, one account is debited, then the other one is credited. So you're debiting the assets account, then you have to credit the income statement. Is that clear? All right. So basically, that is what you do. I have made this point and you need to get it very clear. I repeat one more time. It doesn't mean always you will find a loss. No. So what you do in a nutshell, again, I'm repeating on how you record in the disposal account. Please, you start with the cost, okay? This is the disposal account. The cost of the asset, you debit the account. Then the total depreciation by that time, you record. Then the sale value, okay, the resale value. When you want to sell the asset, you record the resale value. Now, in case when you add, you find that the credit side is higher than the debit side. What that indicates, I repeat, is that there will be a balance here that you send to the income statement. Okay, this balance here since it's a debit, it is referring to a gain, right? It's actually a gain. Now, since it's a gain, you know that gains are credited in the income statement, but in the fixtures, you will debit it like that. That's how you would record. I've made this point. In case you find the credit side is higher than the debit side. Is there any question? So I will give you the question to try, and I'll also share these notes with you so that you can try them again and again just for practice purposes.